Alrighty, folks. So in this video, which is the 20th video of the Maybe series and the 14th under valuations, we're going to be talking about how the valuations under a DCF differ in an emerging economy versus a developed economy, right? So this, like a lot of things related to DCFs, it boils down to our weighted average cost of capital, right? So we know that our weighted average cost of capital is the percentage of debt in a company times the interest rate on that debt times 1 minus the tax rate plus the percentage of equity times the cost of equity, right? And let's say that two companies are the exact same. They have the exact same financial metrics. It's just that one is an emerging company, it is in an emerging country, and one is in a developed country, right? So what do we really see being different here? Well, the percentage of debt is going to be about the same, right? This is kind of questionable. The interest rate, we don't really know whether that's going to be higher or lower. We can kind of speculate, but I wouldn't really go down this path, right? We know that the percentage of equity, because it's the exact same company, is going to be the same, right, in terms of capital structure. However, what does differ from country to country is the cost of equity, right? And we know that the formula for cost of equity is equal to our risk-free rate plus our beta times our market risk premium, right, which is the return on the market minus the risk-free rate, right? So let's actually run two scenarios here. So I'll draw a line down here and I'll rewrite the formula here. The risk-free rate plus beta times the return on the market minus the risk-free rate, right? So let's say that on the left side, we're looking at a developed country, right? Well, let's say that the risk-free rate here is, let's put it at 3%, right? Let's say the company is just as correlated as the market is, so beta is 1, the return on the market is 10%, and the risk-free rate again is 3%, right? So that gives us 3% plus 7%, which gives us 10%, right? So our cost of equity is 10%. Well, let's look at an emerging economy, right? Well, in an emerging economy, typically the risk-free rate is higher because that country hasn't really proven that they truly are as risk-free as some of these other developed countries, right? So even if you were to, for example, loan your money out to a country in an emerging economy, you would say that that is riskier than loaning your money out to the United States. So because of that, you're going to require a higher risk-free rate, right? So let's say that the risk-free rate here is 7%, right? Let's say beta is the exact same, and the return on the market in those emerging economies is typically higher as well, because investing in those emerging economies is typically riskier. So we're going to assume that the return on the market is also going to be higher. And again, the risk-free rate is 7%. So what does that give us? That's 7% plus 1 times 15 minus 7, which is simply, 8%, right? And that gives us 15%, right? So we can see that our cost of equity is higher in our emerging economy, right? So if this is higher, right, what does that mean for our weighted average cost of capital? This is simply an input in this formula, right? And if it's a greater number, that means that our weighted average cost of capital is also going to be greater, right? And what do we know about that? Well, we know if our weighted average cost of capital is greater, that means that our valuations are going to be lower, right? Because you're discounting each cash flow that this company gets by a bigger number, right? So in a developed country, you have $100, $100, $100, and you're going to discount that all by 0.1, right? So that's going to give you 1,000, 1,000, 1,000, right? However, in an emerging economy, you're going to have 100, 100, 100, and all of these are divided by a bigger number, 15%, right? So what does that give us, right? That means that each one of the values of this cash flow is going to be lower in this scenario. So we have this 666.6, right? Six, yeah, I think so. Yeah, right? So when we sum all of these cash flows up, right, we can see that in the developed country, these are equivalent to 3,000. However, in the emerging economy, we can see that this is equivalent to approximately 2,000. Oops, I'll write it down here. Approximately 2,000, right? So we can see that in emerging economies, because the weighted average cost of capital is higher, our valuations will be lower, right? And you could look at it the other way. If our weighted average cost of capital is lower, right, in a developed country, then our valuations will be higher, right? So I hope that's been helpful in terms of understanding how our DCF is going to give different inputs depending on whether we're in a emerging economy versus a developed economy. So I hope that's been helpful, and we'll hop into the next one.